How did the how your challenge going so far?
Oh, I failed it, right? Yeah, I failed it.
Okay, well, you try, always try again. Yeah, always try again. Okay, I think one of the last things we left off on was we talked about a system, a system regarding the markets being manipulated and program within, well, we could say manipulated or program, however you want to place it, but it's done by an algorithm. Okay. And I think we did the exercise where I told you to either, if you mark the first of the month, mark either 20 days out, 40 days out, and then 60 days out. You recall?
Yes, yeah.
Right. So when we mark those days out, they're usually what's the parameters are regarding the interbank price delivery algorithm. We know we can't outdo the market. I mean, the good thing is, it's a program and all programs, the thing is with all programs, with all computers, with all AIs, whatever it is, it's still man-made.
Yes,
So man had to program it. And so simply because man had to program it, no matter what type of electronic device or whatever it is, that means it still has limitation simply because man created it. Once man created something, it have limitations. When we think of, so that's like our starting point. But when we think of the framework or the total cycle, so to say, of trading, when we think about the total cycle of trading, what you have to really grasp and understand is our phases. We have different phases when it comes to trading or different areas that price would go through. We already know, well, first of all, it will be trending no matter what trend it is. Either if it's in an uptrend or a downtrend, we're always going to see these areas repeated or this cycle repeated. Maybe not in this order here, but the cycle will always be repeated. So here's the thing now. We have consolidation, we have expansion, and our expansion would be like our impulse. We could say our expansion is with our impulse, because we have our impulse wave and then we have our corrective waves, right?
yes,
So our expansion would be our impulse, then we have reversal and retracement. So within the whole markets, within the whole trading cycle, we know that no matter what time frame, prices fractal. And in every uptrend or downtrend, we always can have a consolidation in that trend, an expansion in a trend, and then a retracement or, in a reverse to change trends. And in all of these, we could always find opportunities. In all of these, we could find opportunities. Well, let me not say all, mostly the expansion, reversal, and retracement, we could find opportunities. But then with the consolidation is our basis for the opportunity. Because with now our consolidation, when we talk about consolidation, you remember the word we use the word liquidity, right?
yes, I remember. Yes,
Okay. So now when we talk about consolidation and we talk about liquidity, what happens as we note during the phase of consolidation is that the persons who control the market makers, or the big boys, what they do is they allow orders to accumulate. So we know In the consolidation phase, orders are accumulating. Orders are accumulating. Orders are accumulating. And what happens is they are there to, they in the market to make money. So sometimes when we see an uptrend or a downtrend and we're right there and we're watching, because even though it may be in an uptrend or downtrend, we really are not sure, which way it's going to go now, because we ain't sure which way it's going to go now, especially if it was a long consolidation. Because usually it's an impulse correction. And then when we see it's consolidating, first of all, we take that as a red flag, as if it's going to be a shift. But here's the thing now, with the consolidation, especially if it's a long consolidation, what happens is market makers, they're accumulating orders. They're accumulating orders. Because remember now, when something consolidating and we're saying it's an uptrend, in that consolidation, what we would do is put our stop loss below, right? If it's an uptrend, we'll put our stop loss below that consolidation point, because in the consolidation, we know that it doesn't move per se at over a certain range. So in consolidation, price moves within a clear trading range and shows no willingness to move higher or lower. So in consolidation, it's a range and price shows no willingness to move higher or lower. And this is important to us in our analysis, because when we talk about trading now, it goes beyond support, resistance, trend lines, and sometimes even POIs. In the phases now, we're gonna start to look for setups in the phases, in the three phases that we talk about, or the elements, or whatever you want to call it. And it's important because it shows, when we see the consolidation, it shows us that market makers are allowing orders to build up on both sides of the market, and it means that an expansion is near. Just as we say, when we see consolidation, it means that an expansion is near. So we look for the impulse into the expansion at the midpoint. So that's our next thing I want to cover now. Because after this, we're going to go to the chart. When we, in consolidation, when you look at consolidation, your top range and your bottom range, I want you to start to pay attention to it, because this is what you're going to notice. You're going to notice that whatever direction price is going to go in, most likely 80 and 90% of the times, it's going to start hitting off from that midpoint. And when I say the midpoint, is like you take the range, it's consolidating the top and the bottom of that range, and then it's the midpoint, the middle point. And what you're going to find is, even though it's bouncing from back top to bottom, when it's someone get ready to go in the direction that it's going to go in, you're going to see it start to move from that midpoint within that range to the in the direction it's going to go. And when it starts to expand or impulse, it's going to impulse off that midpoint. So that's definitely one thing to notice. So that's one of our springboards for when we also looking for trade setups now in a consolidation. So in a consolidating market, what we're going to look for is our midpoint. And when we look at our midpoint, we would see that price springs from that midpoint in the direction it's going to go most of the times, if not all of the times, and most of the times. 80 to 90% of the times you would see that happening with the trade. So that's the consolidation. So we know when we're consolidating, that give us a hint also. So it's not necessarily, if it's an uptrend and consolidating, we continue in an uptrend, because we talk about market makers now accumulating orders. Because what it may be sometimes too is, even if we ain't sure if it's going to go up and it's going to go down, Where it may likely go is where the most orders is, because they're looking to take liquidity. So if they have more orders, if you're saying it's an uptrend, you think it's going to go up, and you place your order at the bottom, your stop loss, so your stop loss at the bottom, or your order at the bottom to go down, or someone is looking for the market to turn around and they have their order to the top, or their stop loss to the top, whichever side has the most liquidity, the market is going to go in that area, because it's searching for the liquidity. And we wouldn't know that. We wouldn't know that until it takes off. But that's what the system is doing. That's what the algorithm is doing, because they are there to make money. We're there to make money too, and they're there to make money. We're not just in the market to take money. If we're going to take that money, we have to think how they think, and we have to move, with sense and with wisdom, to try to conserve our capital. And that's one of the reasons why I like swing trading and day trading. Because as we mentioned also before, in the cost, when we trade from the lower time frame, yes, price is fractal, and the structure that we can see on every time frame. But when you get your pullback at the higher time frame, it's it's more concrete. When you get a retracement at a higher time frame, it's more concrete, that it's more likely that that trend will continue if it retraces, and then bounce off that retracement in that area. It's more concrete. So that's our consolidation. So yes, note that consolidating. We're gonna look. We're gonna mark off our midpoint, and then we're gonna look for price to springboard or push off of that midpoint in the direction, from the midpoint. So if it lines up with our bias of what we was thinking, so if it was an uptrend, like as we said, and then we see price consolidating between the range, and then it start to narrow out, and then we see it just start to spring from the midpoint top upward, then that'll give us an indication that yeah, it's gonna continue to go up some more. But we still watch it. We still gonna watch it, and we're gonna talk about why also. But that's something for us to look at, because we want to say them. We just want to establish some things about the different parts of the trade before we go further. Expansion. So we talk about the impulse now, and we talk about expansion, and we know that expansion is just when price moves from the midpoint of the consolidating range. So that midpoint of the consolidating range, when it moves, and when it moves quickly, that is a great indicator that the direction is confirmed after the retracement. So after we see that retracement, then we know that direction is confirmed. But then expansion itself is that impulse. It's that impulse from that midpoint. And so we know that our expansion stage has begun. And when we talk about retracement now, when we talk about retracement after the expansion, in the retracement, we gonna look for our fair value gaps and our liquidity voids. You remember the fair value gaps and liquidity voids, all right? Liquidity voids. You can see the screen, right? Yeah, okay. So it's remember the market after all, we're gonna go to chart anyhow. Remember the market after always be balanced. And so just like the fair value gap, the liquidity voids happens when it's that big impulse, like a big push up, but like no down for a while. Like you may see 3 consecutive 1 hour candles going straight up, and there's nothing to balance it. And so it's like a void. And then as with those voids, you will always find gradually price goes up to fill those voids. That gap right there is the liquidity void. But as I said, we go to the chart and look at it. So when we talk about retracement now, price impulse from the consolidating area, price impulse from the consolidating area midpoint, it expands. When it expands, then it retraces. And when it retraces, if we see that retracement, it's retracing to either fill the void, because the market always have to be balanced. It's coming to either fill a fair value gap that it may have left behind. And then it's also coming, as we say, to retest that area. So when we see after the expansion and the impulse, the best time, as we noted in previous studies, to enter the trade is when it pulls back or corrects, not on the impulse. Yes, of course, people can trade on the impulse, but it's best to wait when it comes back, because what you'll find out is you get to stay in the trade longer if you're patient, because most of the times when you catch the impulse, yeah, you could catch the impulse for person to scalp or just looking to get something and go out. But what you will find with that impulse is sometimes you're thinking, oh, the trade is going to go, 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 and it come right back to turn around, because it either left a fair value gap, liquidity void, or it's coming back to retest that area to deal with those things, because the market always have to be in balance, and then it push up. So to stay longer in the trade, as I say, it takes patience, especially if you trading from the 1 hour time frame or the 4 hour time frame. That means you have to wait for that 4 hour retracement, or you have to wait for that 1 hour. You have to wait for that day retracement, and that day retracement to that point may take a couple of days, or even that 4 hour retracement may take a couple of days to reach back to that point. But the more patience you have, the longer your trades will run, and the longer you can, execute more pips. Probably now, yes, you can make pips on the impulse, because sometimes, it impulse for a couple hours straight. And then, depends on what type of trader you are, you get that and you finish, you know. But, for a day trader who want to trade the whole day, and swing traders who even want to do a couple days or whatever, it's always better to wait for that retracement, which what happens better on the higher time frame. These things can still be applied, as we say, to scalping, but it's short-lived. It's short-lived with the scalping. So that's what the retracement is. When we see that retracement, we're gonna know that to look for these things. Then we have the reversal. So in the reversal now, as I said, in the reversal now, price is working to move in the opposite direction. And before it move in the opposite direction, it mainly does this by taking out the highs and the lows of a swing. It takes out the liquidity. And we're going to go to the chart, because all of this we talked about before when we talk about taking out the liquidity in the reversal. Because remember when we did the exercise with days, when we mark it off day by day, and then we looked at each day and we saw where price either would go for that high or low for that day, and either go lower or go higher, right? Okay, so that's like a reversal. That's the setup now for a reversal stage of the trade. Okay, let me go to trading view. Okay, we have up on the screen now. Any questions before we go on? Okay, so we have up on the screen now Great Britain pound versus the Japanese yen, and we have this on the daytime frame. So again, now even without indicators, once you start to understand the phases, you can choose like anyone, even as we go further, just to trade off of that. Either, the reversal, or look for when it's consolidating, or when it's going to expand. Let's do this. Okay, so first, this ain't really a good one, but anyhow. This one ain't too good because the cap, but we could still use it. This one isn't really too much of a good one because yeah, it capped. I'm gonna look for a different one, a different consolidating. But this is what I want to show you. We're gonna look for a different one on the screen. This one isn't too good. Um, but we could still see it, because it started the gap.
Mm-hmm.
But but you can still see. Let me make it a little bigger. What I just used just now was the GAN box tool because I just have it set. I think we went over the GAN box tool, right?
No, I didn't. I think yeah, we did, but we didn't. I think we did do it thoroughly, but yeah, we did.
Yeah, okay, well we can because um well settings. I just click on it now. I go on for setting. Um what I have here is I just have it so like I could get the middle point, the midpoint of the consolidating range. So I have that set. So as you can see, I have my zero. This first one I have zero tick. Then the bottom I have one. And like in the middle range, I have the 0.5. So in these three, I just have the middle range 0.5. Out of these four, I have just have the zero to the top and the one to the bottom. So that's like three lines. And out of my three lines is like my midpoint is halfway. And then I think with my color, yeah, my background, I bring it light. I didn't do it too dark, so I could like, I really didn't want any coloring. I wanted it light. So I just did the background, but you can fix the background however you want to fix the background. But the main point is just for that box, for when you put it over the range, you would get like a midpoint. You got that?
Yes, ma'am.
Okay. So here now, as I say, I put it to the top here, to the tip here, and then I put it where it touched close to the bottom here, where we saw the lows. So we can see as it came up, it dipped down and then it started to consolidate on this time frame right up in here before it broke out. But this is what I want you to notice. When it came up and it started to bounce, right? It came up, start to bounce. And then it gave a hint up here
Yeah.
to this tip. It stayed down here to the midpoint for a while before it went back down. As I said, we can look for a different example because the only thing now with this is you can't, because it just, when the market open, wait, what day this is? I can't say that. That's Friday. Yep. So that's Friday. And I mean, this is Sunday or Monday.
Yeah.
Anyhow, this is the date. So
I see it.
we can know this gap happened when the market opened. So when the market opened, this gap looked like this occurred. because the last one was on Friday. This last candle was on Friday. So most likely this gap occurred when the market opened. But the point is for us to see um, how it start to just, because this is the daytime frame now. It started consolidated to the bottom part of a range based on our midpoint, and then it went to the top and started consolidate. When it gone back to the bottom, it didn't consolidate. It went down to the bottom. For those, it just went down as it's going, as if it was going to trend down. But what happened is, as soon as it hit, to say, well, probably take out the little liquidities to these low points, to these two lowest point, it went right back up. Um, let's see if we can find a next longer range. Um, mm, it's really too long. At least it's today. It seems too bad. Could we use this? Let me try it. But I just hoping you get the idea of what I'm trying to say. It's too small. This is a drop. You know what? Gold gave us some good consolidations. I forgot gold. XAU USD. XAU USD. Gold has given us some good consolidations. So let's look at gold. Oops. Um, mm. Shucks, I look at gold. I haven't really started trading back yet. I'm supposed to start trading this week. I think I traded once. Okay, this is a nice. This kind of long right up in here. So let's do this one. It's kind of long. Let's see. We have that tip there, but go from here. Mm, I left out these two little, yeah, just for the sake of it. Let's just still, oh crap, let's just still do it. Okay, so this is gold now. Because with gold, one thing to say with gold, once it consolidated a while, if it can catch the consolidation phase, and you can catch when it go to impulse, you gotta, it's a good opportunity for you to be able to get that push. So here is what we was talking about, and really looking at the consolidation phase now and applying that to our trading. So we have this consolidating on the daytime frame. And as we can see, yes, it's in a range. We have our tip right here. We went to the tip. I was going to go to the body, but we went to the tip just for the fun of it. And then we went to this tip. So this was our high, this was our low, and price was trading within this range. And so, as we say, first of all, with the algorithm, which is man made, because the market is getting harder and harder to beat. So you have to try to move with the punches. So we can see first when it starts, we get that up, down, we get that up, down, and then now we get price just bouncing off of mostly the mid range. Pounds price bouncing off the mid range. And when it did start to go up, man, because these were little moves, because these were day candles, compared to these drop here or these impulses, these candles, like tiny. I mean, I know I have it small, but you understand what I'm saying.
Yes, ma'am.
But we're seeing where in the consolidation phase, instead of us now, yes, it's an uptrend and we're thinking it's going to go up. But now we have a better idea if it's going to continue up when we see it bouncing or platforming off of that mid range. So now we see as the consolidation go, we see it continuing from that midpoint, from that midpoint. So yeah, forget all the indicators and everything now. We just looking at price action and what on the chart, and based on what's on the chart and based on our knowledge of what to look for now in the consolidating range, we can see that price going for a while now, and even at the end, it started the platform from the midpoint upward. Now, if it was going to platform from the down point upward, then we would have said, now price is probably going to go down. Um, but you understand
Yes, ma'am.
you understand the point, right? So even with this, you could go ahead and with different instruments, you could go and look for the consolidation range and apply your tool and just back test it and see what happens. So now that's consolidation. So now we talked about when we talk about price um expanding, and this is also a good example of that now because, well, first of all, price. This isn't a good impulse, but price, because price it was so choppy and price moved. Price moved. Hold on, let's make this bigger. So when we could see here now with this daily time frame, when price moved, it was a little choppy. It pushed away. It never really came back. Besides this, after it breakout, our high, because our high is right there where our line is. So we have our tip right here, right almost on the line. Then this is the candle would close above the high point here, this green candle. And then we have where price came back and retest that area there of the break above, but it still didn't go, down, but it came back and it retests that area. So up in here is kind of a little check and balance per se. I'm sure if we look, we'll probably find some gaps there. But this is what I want you to look at now when we talk about the liquidity void. This is our liquidity void. Unlike how we could see these candle moves and you see a little red and green, then red and green. But if we notice here, when price pushed, you have consecutive green candles and you already have no pullback per se. So before So right here, this is our liquidity void. So this is the market. Remember, we said the market always have to be in equilibrium, or the market always have to balance. And so now for what, I won't even count this because it come here and then the push up. So 1, 2, 3, 4. For 4 consecutive days, we saw a price just push up. And we know that the market always have to be in balance. But for these days, we saw like the the buyers, or those who were going long, they were in control of the market. So you couldn't really find any sellers like that. The sellers didn't step in yet. So we call this here what we was trying to explain our liquidity void. Unlike the gap when it break above and then it leave a gap between the first and the third candle, this is a void. And when we see the voids, that's also a good thing for us. Because remember now the void comes within that phase. The voids come within that phase of the retracement. When it's going to retrace, it's going to retrace to fill those voids and gaps. So we know when we see the market expands or impulse like this, and it leaves voids, it's going to fill those voids, and it's going to probably, if any gaps down there in filling the voids, it's going to either springboard after it filled those voids or hit a gap and impulse back up off the gap. So now, besides, as we expand these things that you have to note, as we expand on ours, first of all, in your consolidation range, you look for your midpoint to see where price is going to impulse from. Then, when it impulse, which is the expansion range, when price retrace, you're going to be looking for it to fill voids if it left voids behind, and looking, well, you already know to look for the fair value gaps. But especially when it's voids, when you see that voids or them big up candle, just be patient. Be patient because it's gonna come right back down to fill those voids, and then you could look for it to go up in that direction, depending on if it is in a reversal. Let me we can get to that too. If it is in a reversal, where it was sent to just take the liquidity and then reverse. But definitely our voids are going to be filled. So, trading takes patience. When we're going to trade, patience is the key. We can't, patience is what's going to help us to make money. It's when we try to rush it. I speaking from all kind of experience and losing money and making money. But anytime we try to rush and we put pressure on ourselves to rush too much instead of waiting for the setup and waiting for what we know to look for in the market, we lose. So right there, we have an example of when the market expands and it leaves voids. So void is another opportunity now for us to be able to springboard off of voids and off of fair value gaps, for more or less the void. As I say, as we continue to expand. And when these things, what we know, we don't really have to use much tools. Only one tool I really recommend on the chart with this, and it wouldn't even probably be the MACD. But with your knowledge of these items, it helps take you to the next level to make sure your accounts start to grow. Okay, so we covered the consolidation. We talk about when it impulse, retrace, and now we need to talk about reversals now, when the market reverse, because these are our items. These are items that we're going to elaborate on and think about every time as we expand during these lessons. They will be like the basics. So they will be like your go-to as we move along. There will be areas to go to as we move along. Now let's make it smaller. Let's see when price. So we can see a good example when price reversed. I think gold is a good one for that because gold may reverse and then gold been going up. Okay, let's do uh, mm, mm, that might be too choppy. Mm, okay, we could use this, even though because this is a daytime frame. This is a daytime frame, so it takes a while. Um, so even though it's like we can still see it still went up gradually. We can clearly see downs and up and downs and up. But because when we talk about the swing, we're gonna talk about the swing property for that week or for that day, and then we know if we talk about that, we'll probably be looking at the 4 hour unless you want to go higher. But this is what let's make this a little larger. I'm gonna look at this area right here. Okay, so I marked those. Okay, let's do this too. Okay, reversals now, reversals. So what we did just now is you could see I marked like the areas of retracement or pullback or when it dipped. And then I married and then I marked some of the highs. So I marked some of the lows and I marked some of the highs within this leg of this uptrend. So in this portion here of this uptrend, I marked some of my lows and I marked some of my highs. So from Tuesday, let's say from Tuesday, October 3rd or October 3rd or 4th. So from Tuesday, October 3rd to December. So the whole month of November and this too. So from October to December, we have this swing. This is a swing. So from October 3rd to December 27th, this pair was going up. This pair was going up. Now, when we say reversal, this is what we look for. As I said, this is like our basis that we have to expand on. So these things definitely you have to keep locked in. When we talk about reversal now, as price came down, remember, we say the market is looking for liquidity. And we also noted that, hey, well, if someone went in a trade up here from down here and they see the market going up, why did it just move move their stop loss up or something like that. But remember, with with we are the retail traders, and then we have to buy. Persons who get come into the trade here and hold in position and really can't move is those big hedge funds. The big hedge funds, they either open a position, hold, and then when they get a certain point, they close. They don't like trade. So they may open a position here and that's gonna stay open and price rises all the way up here. And the algorithm sees that liquidity, and so it's trying to reach now for that liquidity, because the hedge funds, they have mandates, and then they have portfolios and different things. So when they put their big orders in, their order pretty much sits. So what happens now when we see like how the market came up here, it peaked, it came down. When it went up, it didn't go up to create a new high. It came back down. So the first thing we need to keep in mind is, where are the liquidities? And as the market comes down to go in reversal, the first thing it does is go to reach for the liquidities that are sitting there. Okay, so even as it came down, when it came down here first and it rallied back up, when it came down here, it reached for this liquidity here. It grabbed this. Whoever was sitting here when price dipped here. So this is now a reversal now. So we see price grab this first one here, liquidity, sitting there, and went up. When it came down, it went to grab this here, liquidity. And not only this here, this one close, but as it come down, it came up, come down, and it grabbed what was sitting here. Because most likely for this whole leg, remember I say within the swing, there's consolidation, there's reversal, there's retracement, there's expansion. Even though we can't see it much at this point, our consolidating area would probably be up in here. Because this seems like this moves good. I don't even trade this like that. I probably need to look at this. Just put this up. But price came down, it grabbed the liquidity here, it went up, came down, it took the liquidity here, and went down, it grabbed the liquidity on this side, it came and grabbed the liquidity here. Now, in this whole leg, it did not take out the low. In the leg where it first started, when it came down, it didn't come to take out the low. It came close, but it did not take out the low. That point. It came, then it started to rally back up. So then this is a net swing. This is a consolidation. This is a consolidation up in here. And the big one, but it's consolidation. With this consolidation here, let me cover everything. With this consolidation here, we have a up point, we have a down point. With this here, this pretty much was almost touching both ranges. It was almost touching both ranges. But at the end, for the last couple of days, we see it springboard off of the mid-range. When it came back, it retraced, touched the midpoint, but it didn't go above it, and then it came back down. So even though this was like a drop, even when it came up, because this came down, and even when this candle opened, it went up a little. Hold on. Excuse me. So you can see the little wick. Let me make it bigger so you can see the wick. So when this candle came down, the second candle was created. It went to go up, but it wick right back down below that. When the other candle came up, it went to go up and it wick right back down. So even as we drew our box, we can see that it started to springboard from the midpoint here to turn around now from this leg that we shift to now, this new leg. And the same thing applies. As it comes down to sweep liquidities for persons who would have entered the trade here and they saying they safe. Because remember now, we are retail traders. It's the big boys that move the market. So they have hundreds of thousands and millions of dollars sitting there. And we have the market now coming because it's still sitting there. They can still see it's open. It's still sitting there. They can still see the liquidity there. So now it comes down and take out those liquidity. It comes to take those liquidity. Comes to take it. So as we see price coming down, when we look left, we look at that level to see when it takes it, and as it go lower to take out liquidity. We just change up our terminology a little too, because then we would say, okay, they are retracement areas or order blocks area. It went back to old order block, because then you remember the shift would be the breaker block. So it went back to old order blocks area. So that's there. It is your cycle, especially for your reversal part. So now as we continue to go to the course, that's our basis. And we have to expand on reports and different things to make it more solid. But let's go back to share. So as we go through the course, which is 3 months, so this is like your short now, but you're gonna have assignments. So don't think it's a little tedious. The assignment is as the assignments go by, you may think it's tedious, but it believe me, it helps to build stronger trading skills. But for now, what I want you to do, because these are also shorter, what I want you to do is go now and back test. Look for your consolidation with, if you trade 3 particular things or 4 particular things, we only meet once a week. So go and expand on that. Go and find your consolidation. Look at your midpoint and see what we say so far. Because this is like our frame.
Yes, ma'am.
What we gonna pardon me?
That's it. Yes, ma'am.
Yeah, what we're gonna build about. Look for the expansion stage and look to see if that expansion stage push up from the midpoint. Look at your reversal. When your reversal happened, look to see if there was liquidity voids or fair value gap, and then look to see if price was more opted to come back if there were liquidity voids versus if there were liquidity gaps, like which one it came back quicker to. And then look for your retracement. Sorry, that's your retracement. And then look for your reversal where it take out the liquidity. I hope I said that right just now, because I think I trip up. So your reversal is when it's going to take out the liquidity to reverse down now in a downtrend. And the retracement is when it's going to look for liquidity voids and liquidity gaps. You get that?
Yes, ma'am.
Yeah. So I want you to show me that whichever, I'm not sure how much pairs, how much things you trade, but I want you to at least already have 3 charts mark up indicating you back tested what we talk about. That is our framework for class on Saturday.
Yes, ma'am.
Okay, because we're gonna get into a little more stuff as time goes. So next class, this will be like the slowest class. This is the framework. This is gonna be the slowest. So the next one gonna be a little more packed. Okay, so just be a little prepared.
Yes, ma'am.
All right.
Yes, ma'am.
All right. So enjoy your night and see you Saturday morning, God's willing. And if any questions or anything, as always, message me. I'll
Yes,
call.
ma'am.
All right. Good night.
All right. Good night.
Uh,
I was a day with the food truck. It was a food truck, eh?
no, no, I I prepare meals from home. I take orders.